Over the past decade, global investing has been dominated by one powerful trend: growth stocks leading the market. Companies promising rapid expansion, disruptive innovation, and future potential captured the imagination of investors worldwide. From tech giants to emerging startups, the focus was clear: prioritize future earnings over present value. But now, something significant is happening. A major shift is underway, one that's quietly reshaping portfolios, strategies, and even the way investors think. This shift is from growth to value. So, what exactly does that mean? Growth investing focuses on companies expected to grow faster than the market average. These are firms reinvesting profits to expand, often trading at higher valuations because investors believe in their future potential. On the other hand, value investing is about finding companies that appear undervalued, stocks trading below their intrinsic worth, often with stable earnings, strong fundamentals, and consistent dividends. For years, growth stocks outperformed value stocks, creating a long-standing imbalance. But markets don't stay tilted forever. To understand this shift, we need to look at the broader economic backdrop. For much of the 2010s, interest rates across major economies remained historically low. Cheap money fueled innovation and allowed growth companies to borrow easily, invest aggressively, and scale rapidly. Investors, in turn, were willing to pay a premium for future earnings because the cost of capital was minimal. But as inflation began to rise globally, central banks were forced to change course. Higher inflation led to higher interest rates, and this is where everything starts to change. When interest rates go up, the present value of future earnings declines. In simple terms, money expected far in the future becomes less valuable today. Since growth stocks rely heavily on those distant earnings, they tend to suffer the most in a rising rate environment. Value stocks, however, with their steady cash flows and near-term profitability, suddenly become more attractive. Another factor driving this shift is market maturity. After years of rapid expansion, many growth sectors, especially technology, have reached a level of saturation. While innovation continues, the explosive growth rates that once defined these companies are naturally slowing down. Investors are beginning to question whether the high valuations still make sense. At the same time, traditional industries like energy, financials, and manufacturing, often categorized as value sectors, are experiencing renewed interest. There's also a psychological element at play. Markets move in cycles, not just because of data, but because of investor behavior. When one strategy dominates for too long, it often leads to overcrowding. Too many investors chasing the same growth opportunities can inflate prices beyond reasonable levels. Eventually, the market corrects itself and capital flows toward areas that have been overlooked or undervalued.